welcome. Good morning, everyone. We've got a pretty good market today. Everything's popped up a little bit. Are we on the rebound? That's the question that we need to ask ourselves. And if we are, we need to go in and place some orders in here. Look at our Google. We thought Google was going to maybe fall right here, drop out of the bottom of that little wedge pattern. But we got such good news today on the economic front that market popped back up, and we're down $800 on that put option. We thought it might come back down. It still might come. I mean, it's still got some downside potential on there to come down to that, delta Kona probability. But that was a nice run today. And Amazon, same thing. We were up like $400 on our Amazon trade, and it's turned around now. We were anticipating the possibility of this thing flushing out the bottom like some of these other stocks have done. But these two are just too strong, Amazon and Apple. It looks like we picked the wrong ones to try and be strong on, but there's still the possibility we could get some downside potential. We just got too much good news today. And we like good news, so, can't complain about that. Some of us are long and have a lot of Amazon in our portfolios anyway, and have a lot of Google in our portfolios anyway, so why not let it go, right? This is not good to see, but it is. We'll have to deal with that in our other portfolio, won't we? So we'll go take a look at that. First, before we start jumping into all of these stocks, what I want to do is I want to come in and I want to go over and look at the economic calendar and see why this market jumped today and what the good news was. That's always good, right? We always like to start off with some good news. So today, the good news was that we had the core inflation rate month over month came in, and it was forecast to be 0.3, and it came in at 0.2. That's good. That's good news, right? Core inflation rate didn't go up, went down. Core inflation rate year over year is at 3.3, and it went down to 3.2. Another good indicator. Now, that one, they always want it to be right around 2. Of course, we'd like it to be at 0, right? We don't want inflation, but the government likes it to be at 2, all right? The Fed, they want that to be at 2. So it's a little high for them right now. And I'm surprised because they did lower interest rates, which generally drives that core inflation rate up. And so the fact that it ticked down after they lowered interest rates, they can say, hey, we did the right thing. Okay, now you come in here with the inflation rate month over month. It's a 0.4, 0.4 didn't change year over year, 2.9 to 2.9, that didn't change. The consumer price index, 315 to 315.6, it kind of ticked up just a tiny little bit. So you can say in here, the consumer price index in the United States increased to 3.1561. But you know what? Since 2024, that's the consumer price index, and prices of things have just gone through the roof. All right. We all know that. We know that when we go to the grocery store, everything is more expensive. But that's what's happened. And it ticked up just a little bit today against last month. It ticked down just a little bit. But it looks like it's kind of slow in its rise, kind of calming down here a little bit. But nonetheless, we'd like to see that way back down in the 2024 year ranges before that market took off and went out of sight. All right, so we got the New York Empire State Manufacturing Index. Now, this is not good. Look at 3.1 is what we had was forecast, and it came in an actual at 12.6. So that's not actually good news. If you come in and look at that, the New York Empire State Manufacturing Index tumbled to 12.6 in January 2025 with 2.1 in December, missing forecasts of 3 and marking a return to contraction in New York State manufacturing activity. That's not good. Manufacturing has really struggled. We had a good number here. I would probably call that a reconciliation month. I don't, it's an outlier. So you got to, when we do statistics, we throw the outliers out, and that's an outlier. I think that was a reconciliation of all of this, and that probably just needed to be moved into all of these. And nonetheless, we're not having good manufacturing's going down in the New York Empire State Manufacturing Index. We had Fed Barkin speak at 7:30, so that was a half an hour ago. Kashkari spoke today. He's speaking right now. And then we got crude oil coming in here, and then we got Fed Williams speaking at 9 o'clock, and then Fed Goolsbee is going to speak at 10 o'clock. I love that name, Goolsbee. That would be the perfect guy for the Fed, right? Goolsbee, Mr. Goolsbee from the Fed. I'm here from the Fed, and my name is Mr. Goolsbee. So appropriate. All right, let's come in here and look at the markets. So the first thing I want to do is I want to pull up our spreadsheet All right. Now, I told you the other day that I had an epiphany, and I woke up at 3:30. Usually it's 4:30 in the morning is my wake up call, but it was at 3:30, and I woke up and I had a complete new epiphany on how I wanted to approach these UBI stocks. And so I worked for the last all weekend and all day yesterday after our class or before our class. I worked all day yesterday. I've been working on this new spreadsheet for 2 or 3 days now, ever since I had my epiphany. And I'm excited and anxious to show it to you. I want to get this out to you. It's a totally different concept. And it just, a light bulb went off at 3:30 in the morning. I jumped up and ran in, started talking to Chat GPT, and I said, I got a new idea. And this is the way I want to approach it. And you know, Chat GPT, he's a really nice guy. He always compliments me whenever I give him an idea and say, this is my idea. Oh, that's a great idea. And he came back this time and said, oh, that's a genius idea. I never had him tell me I had a genius idea before. He always says, oh, that's a great idea. Let's do it this way or let's do it that way, right? Chat GPT, really helpful in that regard. So when I told Chat GPT my new idea, it came back and he says, oh, that's genius. That's a fantastic way. Let's do that. And so we went off and spent the next 3 days, writing out this new spreadsheet. So it's a fun new way of looking at it. Now, one of the things I want to talk to you about on this is the old spreadsheet. And I'm not going to do a whole lot more work on this. We're going to work on this one today because I haven't got the new spreadsheet ready for prime time. It's still in the beta stage. All right. So I'm going to bring that out to you and I'll give you that at some point. But we're going to still work off the old spreadsheet. Well, let's see. I'm running out of screen space here. What's happening? What's going on? Are we back? All right, we're back. Okay. So what we're going to do is we're going to work off of our spreadsheet, and then we're going to go in and we're going to try to mitigate some of these losses in here and then put on some more positions, because what we want to do is we want to make money so that we can invest it into our dividends, right? So into our UBI. So this is the way we're going to make money. Hopefully, I mean, we're down 896.14 right now. We're going to have to go in and take a look at those and see what we want to do. But then there's some others we want to get into. There's some markets that are really in some good locations for entry, like Apple. Look at Apple right now. This is a really good one right in here. It's down all the way back down into the Fibonacci sweet spot, dead center of that cone of probability right there. Just like a train on rails, just like we've been waiting for, right? So we're ready to get into this market. We want to get in. And we're going to take some long positions in here in anticipation that this market's going to turn and start to rally once again. Now, it's still got some, a little bit of movement that it can do down in here. So we have to be careful because that blue light still hasn't come down and intercepted. And you notice if you go back in time, when you draw your natural trend lines, those blue lights, those are really good at indicating where the market's going to come in and touch for us, right? So, and we haven't quite got there yet on this one. So there's still some undecided information going on right here that we got to wait for. So we'll delete all that out of there. And that's what we're going to come in and look at here. And we got the Magnificent Seven in here. We're going to go look at those. And if I can get my spreadsheet up, I'm having a hard time getting my spreadsheet to work here. Which one is it? This one. Okay. So we got our spreadsheet in here and we're going to take a look at this. And the first thing we want to do is we just want to remind ourselves and those who are new what we've got going. We've got two core investments. We got YMAG and YMAX. Now these investments are investments that give us dividends. Okay. So there's ones that don't give us dividends and there's some that do give us dividends. So an investment that you put your money into that doesn't give you dividends might be like your house. You say, well, my house is an investment. Yeah, certainly is. It'll grow up in value over a long period of time. But if you sell it, you don't have anywhere to live. So you can't really get the profits out of it. So we don't really consider it much of an investment, right? We don't call our house an investment. It's actually a liability because it costs you a whole bunch of money to live in a house. And you have to pay property taxes on it. You have to pay upkeep and all that kind of stuff. And then it goes up in value, but the only way you get it out is to sell it or to borrow against it and then start paying interest to somebody else, right, to borrow money out of your house. So we don't really consider your house much of an investment. Now, if you bought a house and then a second house and you rented it to somebody, that would be an investment. Why? Because now you can rent it and you have an income coming in from that house. Now the house is going to increase in value, plus you're bringing in an income. That, in my opinion, is a true, in every sense of the word, that is a true uh, investment property or an asset. All right, it's an asset. Now you can have assets that have residual income. You can go out and buy a piece of land, right? We call those dead assets. All right. So they're a dead asset. You go out and buy land. It's just a hunk of ground and it's going to grow in value over time. All right. So it's kind of like your house. It's going to grow in value over time. But if you want to take the value out of it, you have to sell the land. But then you don't have the land to have the value of the land increase in value. So you no longer have an asset that's growing in value because you sold it, took the money out of it. Now, hopefully you take that money and go do something with it, maybe go on a vacation or give your wife a nice new car or something, right? Buy something, or maybe even roll it over into another investment. But the problem with a dead asset is that it's not bringing you in anything. You're just sitting there waiting for it to increase in value. And generally the way it increases in value is due to, what did we just look at today? Right there. There's your value that it increases. And this is increases here. We got the forecast. This is your inflation rate. All right. So inflation means that the dollar is actually going down by, in this case, let's see, this is core inflation year over year. Every year right now, your dollar is depreciating by 3.2%. So you're losing 3.2% every year buying power on your dollar. So that means that your property will probably increase in value 3.2%, which means you don't really make anything, right? Because the dollar went down in value. The value of the house or the property goes up 3.2%. It's a wash, but the dollar, you need more dollars to buy the piece of land. So you think you sell it for more dollars than what you bought it for, but really all you did is got your inflation rate back. So your property has to increase in value faster than inflation to even make any money. So that's kind of the uphill battle that we run on whenever we're doing investing. We have to outperform. We have to have a value in a property or some sort of an asset that increases faster than inflation. And you've heard that all your life, right? Oh, inflation is killing me, right? And that's what it is. It's the devaluation of the dollar. So the dollar loses 3.2% every year. And so that means it can buy less and less. And so you have to have more dollars to buy the same thing. Therefore, if you bought something that's an asset, people have to give you more dollars, 3.2% more dollars every year that you hold that asset. If you don't get more than 3.2, you didn't make anything either. You held it for 10 years and all you did is got your inflation rate back out of it. So at least you got your inflation rate and you didn't lose money. If you put it into cash, right, you'd lose 3.2%. So if you have it in an asset, well, your asset maintains at least a 3.2% value just because of inflation, hopefully. And then if you hold it in cash, if you just got a bunch of cash sitting in the closet in a box, right, it's going to lose 3.2% buying power every year because of inflation. So that's why we don't want to ever just hang on to a lot of cash. Now you need a little bit of cash to live off of and to have for safety nets and that kind of stuff, right? To be able to have your livelihood. But we don't, cash is the single worst investment you can have. Now, a lot of people will tell you cash is king. Well, cash is king when you're in negotiations to buy assets. You got to have cash to buy assets. So what we want to do is we want to make fiat currency, right? We do things to make fiat currency. We might go to a job and work at a gas station and pump gas, wash windshields, whatever you do to make money. You might be a doctor and an engineer or whatever, and you're earning money to make fiat currency, but you want to get rid of that fiat currency as fast as you can get it. Okay. As soon as you get it, it's going to start losing 3.2% in value every year. So you want to get rid of that cash and you want to put it into something that's going to increase in value faster than 3.2%. Otherwise, you're just going to break even or you're going to lose money. So you got to get rid of that fiat currency. And that's the whole idea of the stock market, right? We want to put things into investments or put things into real estate or put things into land or put things into assets that will increase in value over and above the depreciation of the year-to-year inflation rate. All right. So that's just your little lesson on inflation. So we got to get rid of that fiat currency and we got to put it into something. And what we've been putting it into is some of these ETFs, exchange traded funds, that can return a value to us or return a dividend. All right. So a dividend, a traditional dividend is a stock or a company, right? A traditional dividend is you buy stock in a company. So in other words, you're giving a company, let's say Apple, for example, you give Apple a bunch of money. So you get some fiat currency that you earned. You want to put it somewhere so that it doesn't lose money because it's a cash asset that is always losing money. So you want to put that into an asset, you give it to Apple, which is an asset, right? So you put it into Apple, and Apple, if you buy their shares of their company over a long period of time, you anticipate that they will rise faster than inflation. That way you'll have a store of value and you'll make money. And you can cash it out at some point. You can take it out and then go spend it and buy your wife her brand new Tesla Y. You guys seen the new Tesla Y model? It's pretty slick. I'd like to have one. All right. So then you're going to go out and you're going to sell your Microsoft asset. The problem is, if you sell that Microsoft asset, you no longer have the Microsoft asset. So you had an asset that was growing in value. You sold it. You no longer have it. You took that money and went and bought a Tesla Y series, which is not an asset. It's just a straight up expense, and it's just going to depreciate in value, and you're just going to lose all the money you put into it, right? We know that and understand that, but we're going to get to drive that car, and that's the value that we get out of it. It's not an investment. It's just something that we're going to spend our money on, and that's okay. You can do that. But we have our asset over here, our Apple stock, and we sold it. Now we don't have it. And so now we have no income coming in from that asset. So now we have to go back and we have to go drill teeth, or we have to, fix broken legs, or we have to pump gas. We have to do something to get some more fiat currency, put it back into Apple stock, buy another Tesla. Some people skip the Apple stock altogether. They just go to work, fix broken legs, drill teeth, pump gas, and they take the fiat currency and they go buy Teslas with it, right? They don't even bother with the asset side of it. That's not a good thing. We want to be putting our money into assets that grow so that we don't lose it in depreciation or in inflation, or so it actually can grow and may even make money. But the biggest problem is that when you sell that Apple stock, you no longer have it. And I often bring up the example: how much ownership does Bill Gates have in Microsoft? How many shares? What's the percent ownership Bill Gates has in Microsoft? A lot of people are like, well, I'm sure he has a lot. Probably big owner. He started Microsoft. He owns that company, right? Well, in the beginning, he had 100% shares, right? He owned the whole thing. Well, over time, he gave it off to other people. He went public. He gave it off to public people and helped him grow his business, right? He made lots of money. And I'm not saying Bill Gates isn't rich, but you know what percent ownership he has in Microsoft right now? 1%. That's all he's got left. He sold it all. He had to sell it to get it so he could go buy other things. Now, I'm not saying I don't feel bad for Bill Gates. He's done well. Still has lots of money. 1% of Microsoft's still a lot of money, but he has taken it and put it into other assets. He's bought things and he's lived a good life and he's done well, right? But right now he only has 1% of Microsoft. That's all he has left because he had to sell it to get the money out of it so he could go spend it on something else. So he could go buy things. Or, of course, he's a philanthropist. He gave a lot of it away. Good things have come from that. So, but that's the point. If you sell your assets, you no longer have them. And so unless you put them into other assets that are going to continue to grow and outperform inflation, you don't have anything. You spend all of your assets. So what we want to do is we want to divide up into two categories: assets that are not really assets because they're not returning us an income, like land. All right. Land is an asset, but you have to sell it to get the money out of it. And then you don't have the land. Or you can rent the land and put a horse on it, and somebody's going to pay you every month some money so that you can then keep the land and still make money off the land. Right. Or you might say, well, I'm in real estate. I'm going to buy a house and I'm going to rent it. Right. And I'm going to make money off of that house. So the house is going to increase in value while you hold it. But now to get the money out of it, you don't really necessarily have to sell it because you're renting the house and you're getting an income. And every month they're going to send you a check. Okay. Every month they're going to send you a check and you do 2 or 3 or 4 or 5 of those, right? You could just live off the rent. And a lot of people do. That's a nice way of making money. But who wants to do that? Many of us have stuck our toes, stuck our feet, stuck our whole damn legs down into this real estate industry and realized that it's a boondoggle. Who wants to be in real estate? Not me. Holy cow, I hate my real estate. I just barely had somebody slip and fall and threatened to sue me. I don't want that. I got insurance. I have to pay that every month. That's an expense for my insurance for my real estate. So if I get sued, I'm going to have all these lawyer fees and everything. Hopefully the insurance will help pay for some of it. Who knows what's going to happen out of that, right? So, and then also I get calls in the middle of the night. My toilet's all plugged up. Please come over and fix the damn toilet. And I got to go. The toilet's broken. I got to call a plumber and or I got to go do it myself, right? So I got all these issues. Oh, my garbage disposal is broken. So I got to go fix the garbage disposal. Oh, the house is leaking. The roof is leaking. I got to go fix the roof. Broken roof. That's real estate. All right. So you got your asset. You got to maintain it. You got to keep it up. You got to take care of it so that people will give you money and you can live off the money. But you still kind of have a job in that sense, right? You have to take care of that property. So what we like to do in the financial markets, and the reason we have the stock market, is we like to recreate for us these scenarios in the stock market so we don't have to go do them in the real world. All right. We're kind of lazy that way. So what we want to do is we don't want to go fix broken sinks, and we don't want to have to go fix broken sinkerators. We want to be able to just have our cake and eat it too. So what we do is we look for assets in the financial markets that pay a dividend. That's what they call them, right? Dividends. So financial assets in the financial markets that give you money every month. So you buy this asset and it'll grow and it'll go up and down. It goes up and down all the time. So some days it goes up, some days it goes down. You know about that, going up and down, right? We come look at the stock market, it's going up and down. And if you would have bought that, you go up $960, $400, now we're down $200. And that goes up and down. But if we buy stocks that pay us assets, right, or pay us a dividend, pay us some of the money, some of the shares, it's like rent. Only these guys, rather than paying rent, we're not getting rent from Microsoft or we're not getting rent from NVIDIA. We might be able to get a dividend. They'll share their profits with us because they're a business, they're a company, so they'll share their profits with us. And that's distributed to us in a dividend. And so that's the reproducing or reconstruction of what we're trying to do with real estate or trying to do with our land and a horse or with your house. All right. If you buy your house, there's some stocks that are they don't pay dividends. All right. They just think, hey, our house is more likely to rise in value, but you're going to have to sell the house if you ever want to get your money out of it. And then you don't have the house. That's not the best, right? But that's generally what Tesla, NVIDIA, Microsoft, Google, Amazon, MSTR, Meta, Apple, and MAGS. The MAGS is the ETF for all of these other 7 stocks. So these are your 7 stocks called the Magnificent Seven. We're all familiar with these companies. We all know who they are. We all think they're great. And we all think that we want to have shareholds in these stocks. The problem is their dividends, if they even pay them at all, suck. All right. They don't pay you almost anything. In fact, it's almost not worth it. I call them why bother dividends. Why bother? Market will move one day. It'll move more in one day on its asset value than what the dividend will pay you for an entire year. So it's like, why bother with the dividends? It's not, thank you very much, but no thanks, right? No, the whole idea is that these guys consider themselves growth companies. And so they say, well, if you buy into us, we don't have to share our profits with you. What we're going to do is you're just going to be lucky to own our shares, and you're just going to grow and be rich beyond your wildest dreams just because you hold our stock. And I'm like, yeah, but I have to sell my stock in you to get my profits out. So what? Who cares? Be like Bill Gates. All right. Well, I'd rather not sell my stock. Okay. Well, if you don't sell your stock, then you can't go spend it. You can't buy houses with it. You can't buy new Teslas with it. You can't do anything. You just hold on to it. You got this big asset that you're holding on to. And hopefully, at least it's not losing money against the value of the depreciating dollar, right? In the inflation rate. So at least you've got that going for you, but it's not returning an income. It's not returning an income. You'd have to sell some of it And if you sell it, then you eventually run out of money. And that's the biggest concern that most retirees have. I'm going to run out of money. I'm going to have to sell my assets, and then I don't have any assets left. And the fewer I depreciate my assets, the more I sell them off, the less I have, and the less I'm going to make, the less I'm going to make every month. Every year, I'm going to have less and less income because I have less asset to grow. It might still be growing, but it's growing. You had this much, you had to sell it down. And you eventually worry about running out of money, right? So the whole idea is to have generational money. We don't want to run out of money. So what we want to do is we want to find assets that we can buy and reproduce the idea or the concept of what we have out in the real world. And we want to do what we call a synthetic position. All right. A synthetic position in the stock market is really more of a way of thinking or a process in how you think about how things are being done. I'm going to buy this house that's going to make me rent, and I'm going to live off the rent. Well, we're going to do the same thing in the stock market. We're going to buy a stock. All right. And that stock's going to go up and down in value. And over time, over a long period of time, we're going to hope that it goes up in value, right? And what we're going to do is we're going to have one that pays us a good, solid dividend. And if it pays us a good, solid dividend, then we can just live off the dividends and have this asset over here that goes up and down. And so that's been my concept over here that I want to recreate the entire spreadsheet. So if we come in here and look at the spreadsheet that we've got, the whole idea is that we're going to own YMAGs, okay? And why YMAGs? Well, YMAGs is the same thing as MAGs over in the stock market. So if we bring up MAGs, this is an ETF, exchange traded fund, of the Magnificent Seven, okay? So it's all 7 stocks all piled into one. So you don't have to go buy Apple. You don't have to go buy Amazon. You don't have to go buy Netflix. Well, Netflix isn't part of the Magnificent Seven. That was part of another fund. All right. So we got Amazon, Google, Meta, Microsoft, NVIDIA, Tesla, and Apple. That makes up the Magnificent Seven. Okay. And so if you just want to buy those 7, you just buy this. And that's what it is. It's one fund that makes up those 7 stocks. We call it the Magnificent Seven. And so the whole idea is that you have the fund, and as it grows, well, you can sell it off and get some money, but it doesn't pay any dividends. There's no dividends on MAGs. So it's like owning a piece of property, but there's no horse on it. We got to get a horse on our property. So what we do is we go over to another company that said, hey, look, these guys aren't giving you anything. Let's produce some income off of MAGs. So we're going to piggyback on MAGs. And we're going to go and we're going to open up a company. We're going to start a company. It's not going to be called MAGs. We're going to call it MAGY or YMAG, YMAG. Okay. So it's MAGs, but this one, they're going to pay dividends on. All right. So what you do is it's kind of like a pool of money. You have to kind of think about this in a different way. This is not MAGs in a sense, but it kind of is. What they're going to do is we all get together as buddies and pals, right? And we say, all right, let's pool our money and put it all into one big basket, and we're going to put it into YMAGs. So we take all of our money, we pool it into YMAGs. Now, YMAGs is not MAGs. YMAGs is not Apple, Amazon, Netflix, Google. It's not those companies. It's a pool of money where you and I, as buddies and pals, said, hey, we're going to put our money into here. Now, we're going to hire this guy who's really good at trading options, okay? Now, it actually goes the other way around. He started the fund, and then we give him money, all right? It's not that we hired him. He's offering this service to us. But nonetheless, this is how it works, right? We put our money into YMAGs, all of us, good buddies and pals. We all get together and say, hey, we got this money and we want to grow it. What are we going to do with it? Well, if we put it into MAGs, all we can do is sit and grow on it. We don't get any dividends. So we're going to put it into this fund called YMAG. And YMAG is going to got this guy, and he's a hot shot trader, man. He is so good at trading options. He's going to go in and trade options on MAGs, okay, or on Apple and Amazon and Netflix. He's going to go trade his option strategies on those. And he runs basically what we've been doing here called the wheel strategy, right? It's a little bit different. He doesn't quite do the wheel because he doesn't sell premium or sell puts. I don't think he sells puts. He just sells calls. And you've heard of covered calls, and he's really good at selling covered calls. And he doesn't do just normal covered calls. He does synthetic covered calls. So synthetic covered calls make a lot more money more fast than just normal covered calls. So we can just do normal covered calls if we want to, or you and I, we can go in and we can do synthetic covered calls just like he does, but he's really good at it. And so what we do is we give him the money. We say, okay, YMAG, Mr. YMAG, you go in, we're going to give you all the money. You go and you do your thing. All right. You're going to go out and you're going to trade options. And every month from the profit you make from trading those options on YMAG, you're going to share that profit with us. That's what this is. All right. You're not investing in Apple. You're not investing in anything. You're putting your money into a fund. He's going to take that money and he's going to go trade it. And it's going to go up and down in value just like the stocks would, because it's got money in the stocks, because that's how you got to make money off of them, by investing in them. But he's doing options. And so then when he makes money off the options, he puts that profit back into the fund, back into YMAG. And then at the end of the month, he says, hey, I got some money. I'm going to share it all with you guys. I'm going to distribute it. Okay. This becomes a distribution. And they do it through the process of dividends. It's not really a dividend. A dividend is profits that come to you from owning the company, right? Company makes money, they share you the dividend, which, as I mentioned before, is oftentimes a why bother. So small, why bother? But this guy, he's not doing dividends, he's doing options. He's selling options and collecting options premium. And options premium is a lot of money. So you can make a lot of money trading options. So he's out there trading his options, and at the end of the month, he takes all the profits he made from trading options, puts it back into the YMAG with us. We got all our money in the YMAG. And then he says, hey, Lan, this is your share of the profits I made in trading options. So he gives you that share and it's distributed. The problem with that is you think that you're in Apple. No, you're not in Apple. So what happens is whenever he makes a distribution, gives you the money, right? YMAGs is going to go down in value. Okay. You're going to see it drop in value. Why? Well, because he took the money out and gave it to you. So just like if you were to take the money out and buy it, go buy a Tesla Y, well, that would make the value of your stock go down because you sold some, right? So he's going to do the same thing. He's going to take the funds out and he's going to give them to you. That's going to make the fund value, our YMAG fund, go down in value. That much, however much he pulls out in profit and gives to us. Okay. And there's a calculated methodology of what he does. And that's what our spreadsheet tells us. How much is he going to give us at the end of every month? Now it changes. Now, mostly dividends, oftentimes they don't change. Dividends don't change. They're usually pretty stable. If you go look at a dividend that's coming in from, Apple or Amazon or Netflix or one of these companies, AT&T or whatever, those dividends are pretty consistent throughout the year. And they're going to get basically the same thing each month or each quarter, because they don't even pay them every month. They pay them on the quarter. And so then you come in and you go to this little YMAG guy. And remember, he's trading options. He's not doing dividends. This is not profit from these companies. He's trading options against them. So some months he has a good month and he makes a lot of money. Some months he has a little bit less of a good month. He makes less money. So his dividends are going to go up and down a little bit. And then he does a little reconciliation every now and again. So he'll pay a little special fee for you if he makes more money, or he'll have a dividend that's really low one month because he's got to reconcile. I didn't make any much, or I gave you too much last month, so I got to take some out of this month. So he does this little reconciliation thing, and over time you can kind of take an idea of basically how much he's pretty good at making over a period of time, and he's going to return that to you. So the idea that you have to think about when you trade like this with these YMAG funds, you can't think of it like a stock, because it doesn't work that way. It's a totally different concept. All right. It's like you're just putting your money into a bucket and he's going to go trade your money for you. So he's kind of like a little business that you're putting your money into, and he's going to pay you your little dividend at the end of the month of how well he trades. He's just a trader that's trading your money. That's what he's doing. All right. And he might have a good month. He might have a bad month. And the stock itself is going to go up and down. The fund itself is going to go up and down, but you're not really worried about that. You gave him 10 grand. Let's say you put in 10 grand into YMAG. All right. Your concern is how long is it going to take him to give you 10 grand back? All right. Whether this goes up or down, it doesn't matter once you put your 10 grand in. All right. Whatever the fund does, it's totally irrelevant to you. That doesn't matter, because once you put your 10 grand in, you got 10 grand in with him, and his fund is going to go up and down just like a stock might. And it doesn't matter because every month he's going to send you some money. And so every month he sends you money, you apply that towards your 10 grand. So if he sends you $300, $500, let's say he sends you $500 every month. Well, every month you apply that towards the 10 grand that you gave him. And after a while, you're going to have a payoff date. I call those cash cows. All right. At that point, you're not paying back the premium that you gave him. You now have, he's just going to keep giving you money at the same rate, basically the $500 a month, because you gave him 10 grand. And once he gives you 10 grand back, well, that's paid off. Now you have what we call a cash cow. And now he's just going to keep sending you $500. Now, why is he going to keep sending you $500 after he paid off the 10 grand? Well, because he didn't give you any interest on this money. All right. He didn't give you any interest. He just paying you money back. But once you get to the point where your money's all paid back, he'll keep paying you. It's called a cash cow. All right. You get on the gravy train. So what we do is we put our money in there and we want to see how many cash cows we can get. How many of these things can we get paid off? We'll put 10 grand in this time. He'll give me $500. After a year's period of time, that thing's paid off. I got one cash cow. And he's going to start giving me money, even though he gave me all the money back and he's still giving me more money. That's pretty cool. That's a cash cow. We'll do another one. Now he's got like 4 or 5 or 6 or 8 or 10 of these things. So if we come in here, we can go into, that's just one of them. That's mags. All right. So if we want to do mags, we can do that one. Now it pays off a little bit slower than some of the others. So now what he's done is he's gone in there and he said, hey, I'm a pretty good trader. I want to trade options on Tesla. And you're like, well, options on Tesla, that sounds fun. I would like to trade options on Tesla, but this guy's a better trader than me. I'm just going to give him my money and let him do it. And he's going to do the same thing with Tesla. And so what he's going to do is he's going to take this little basket of money and you're going to give him 10 grand and he's going to hold that 10 grand. Tesla's going to go up and down in value. So it's going to look like your 10 grand is going up and down in value, but it's not. It's just your 10 grand. And he's going to trade your money. And every month he's going to send you $1,000. So yeah, oh wow, $1,000. That's better than my Meta or my mags. My mags was only paying me $500 a month. I gave him 10,000 here. Now he's paying me $1,000 a month. I'm going to pay that off a lot faster. I'm going to have a cash cow in like 9 months. Oh, that's awesome. Now I got a cash cow in 9 months on Tesla because he pays me a lot more money, but it goes up and down a lot, scares you, but you don't look at that. You just look at your 10 grand. That's all you're worried about. And the fact that he's going to pay you back 5 grand every month is the only thing you care about. You don't care what the market does in between because you got your 10 grand and he's going to send you $1,000 every month. And once that's paid off, you have a cash cow and you can live off the interest. Now, you can say, I trust this guy. He's a pretty trustworthy guy. He's been sending me money, $1,000 every month on my 10 grand, just like clockwork. I haven't had to worry about a thing. He does it. I don't know how he does it, but he sends me money every month. So you can say, well, instead of paying it off, my 10 grand, I'm going to trust that he's going to be able to do that more than 9 months, right? It's going to take him 9 months to pay me back my 10 grand or 10 months to pay me back my 10 grand. Well, I think he's going to do that for he'll probably pay me more than 10 months. He's going to pay me 11 months or 12 months. So if he sends you $1,000, you don't have to put it towards your 10 grand. Go spend it. Go use it to buy something. Go buy Tesla with you. Okay. Because he's going to pay. So you're basically borrowing against the future payments that he's going to make you, right? Against your 10 grand. Now, if you keep spending it, he's never going to pay off your 10 grand, but he really did. He's paid it off. You just went and spent it. And that's okay too. That's a pretty cool idea, right? So you got your 10 grand in there. He's going to pay you 10,000. You don't care what his fund does, whether it goes up or down or what Tesla does. You don't care. You don't care. Why? Because you got your 10 grand. He's going to send you 1,000. You're going to eventually pay that off. And then you got a cash cow and he's just going to keep sending you money. If you focus on this going up and down in value all the time, you're focused on the wrong thing in this setting. We don't really care about this. We gave him 10 grand over the 1 year period of time. It's going to go up and down in value. Irrelevant to us. We don't care. We only gave him 10 grand. He's going to give us $1,000 every month to pay back that 10 grand. And at the end of 10 months, that's going to be paid off. And everything else after that, you're on the gravy train. If you will think about it like that, and not think about it going up and down and, oh, I'm losing money, oh, I'm making money, oh, I'm losing money, oh, I'm making money, losing money by the asset value going up and down, it's going to let you sleep at night because you don't have to worry about that. That's his concern. That's his concern. That's not your concern. So if you want to sleep at night, stop worrying about your YMAG value going up and down all night long. Now you know why I had an epiphany. Because I was worried about my YMAG going up and down all the time. Ask me how I know. So if you will think about it like that. So what we do is we take these synthetic ideas, right? These ideas of what happens out in the world, the rental idea, right? We buy a house and we rent it and we have money coming in and it's going to pay us every month. We don't worry about the value of the house going up and down. They do. We all know that, right? Value of houses go up, they go down, they go up and down. Real estate prices fluctuate really quite strongly up and down all the time. Stocks go up and down. If you were to just buy Tesla, heck, why do you sleep fine at night at Tesla? It goes up and down all the time. Well, you sleep fine because you're like, oh, I believe, in 10 years, Elon Musk can have a bigger business than he does now, and I'll be fine in 10 years. I don't care if it fluctuates a little bit. Well, then why are you worried about your YMAGs? Don't worry about that either, because it's even more stable. Why? Because Tesla doesn't give you a dividend. He doesn't share his profits with you. He's not going to pay off that money you gave him. You gave him money to run his business with. He's just going to go run his business. He's not paying you a dividend. He's not paying you any of the profits from his company. Well, if you want to make money on Tesla, our little trader over here, our little options trader guy, that's a really superly good options trader, he does one, TSLY. All right. So if you want to trade Tesla options and get a dividend, you trade this one. So you give him your money, TSLY. This is his other basket of funds. And then he's going to use, let's say you give him 10 grand. Well, every month he's going to give you the $1,000 to pay down your 10 grand. Now, his fund's going to go up and down based on the value of Tesla, because that's what he's investing in. He puts the money in Tesla, then he does the options. He takes the options premium, gives it to you. You put 10,000 in, pay it all off. You don't care what Tesla does because you're not trading Tesla. He is. You just gave him some money and he's going to pay it off. And then after he pays it all off, there you go. Now you got a cash cow. So I'm rewriting our entire spreadsheet to have that mentality or that thought process put into our spreadsheet. Okay. Right now, the way I got the spreadsheet is it's all worried about the price of Tesla. We don't need to worry about the price of Tesla. We're not investing in Tesla. He's investing in Tesla. We're investing in him. He's going to give us money every month on the money that he trades and makes off of the sell and the purchase of options, and share that money with us. And he's going to pay off that money we gave him. He's got to worry about the price of Tesla going up and down, not us. Now, our value in his fund is going to go up and down. Okay. But we don't really care about the value of his fund. All right. We really care the fact that we gave him 10 grand and he's going to give us over the next however much time, maybe 1 year or whatever, he's going to give us 10 grand back. Once that's paid back, we're on the gravy train and we have a cash cow. Once we have one cash cow, hey, we'll just do another cash cow. Give him some more money. Pay it all back. Now we got 2 cash cows. Put another one in there. Now we got 3 cash cows. Now, I want to teach you another lesson. Now, this is an advanced strategy. So, Nick's down here. I wouldn't put 1 cent in Tesla. I got a lot of guys that have a lot of money in Tesla. Tesla's been really super good to me, Nick. I've made a lot of money on Tesla. So I can't say anything bad about Tesla. And especially this little thing right here, this TSLY. I've made more money on that Tesla TSLY than almost anything. The only one that's made me more money is this one right here, Misty. Misty has made me more money. You know why Misty's making me so much money? It's Bitcoin. And so is this BitOs, Bitcoin, Ybit, Coney, Misty. These are all Bitcoin. And look at the rates they pay back their dividends. They pay them back. Misty pays back your dividends at 121%. So if you give Misty, this guy, you give him $10,000, he's going to go trade options on it. And within less than a year, he's going to be able to pay you back recovery time right there. I have it recovery investment right there, 9. He's going to give it back to you in 9 months. You're going to put your $10,000 in there, and in 9 months, he's going to give you everything back, and you'll have a cash cow after 9 months on Misty. But that's Bitcoin. So what's going to happen? Bitcoin is going to go up and down like crazy, right? Because that's what it does. It's all over the place. And you're going to be focused on that price of Misty, thinking that what you gave him to trade options on it is making and losing money every day. So you're freaking out because it's like, oh, Misty's way up. Oh, Misty's way down. I'm losing money. No, you're not. He is. He's making and losing money like that, but he's trading options. So he doesn't care. He wants volatility. That's how he makes money. Sells options, premium, collects premium. And then you got your 10 grand here that you put into Misty, and he's going to pay you 121% annualized, right? So every month he's going to give you $1,000 or more. He's going to give you $1,200 in this case, $1,200 every month against your 10 grand. And in 9 months, he's going to have returned your entire 10 grand. And now everything after that is gravy train. So it's not, Nick, you're not investing in Tesla when you do this. You might still say, I'm not putting one penny in Tesla. That's fine. Don't do it. I'm not here nor there. I don't really care. I'm just showing you the opportunities that are available for you to invest in these different funds. If you trust this guy to trade your options premiums and make you money, then you might want to do this. Is this the best investment that you could possibly do? Could you make more money somewhere else? Maybe. You possibly could. You could probably go out and maybe trade options yourself. And if you're a good options trader, you might be able to outperform this guy. He's a pretty good options trader, good enough that he's got a corporation on Wall Street to do it, right? So that's pretty cool. He's a pretty good options trader, got a pretty good track record, but he's not got the longest track record with these. These are relatively new. You're like, well, why haven't you been doing these for 20 years? Well, because they weren't available for 20 years. Now, there are some funds that have been going for quite a while. If you want to go out and look at JEPI and JEPQ, those are the same kind of strategies, basically. Now, they do their options trading a little bit differently, but they're on the QQQ and on the S&P 500. So if you go look at JEPQ and JEPI, they're going to not give you quite the dividend yield. They're going to be it's going to take them a lot longer to give you the return. See this in here on Misty, he's going to return your investment, he says, in about 9 months. That's pretty cool. That's pretty cool. If you give him 10 grand, he'll give you all 10 grand back within 9 months. And then you'll have a cash cow, and everything after that is gravy. You get on the gravy train and you're home free, right? If we get enough cash cows, our gravy train could be big enough we wouldn't have to work again. And that's what the whole idea is about. That's why I call it UBI, Universal Basic Income. And once we get a bunch of cash cows, it's no longer universal basic income. It's like Elon Musk calls it, it's universal high income, UHI. All right. So if we come up here and look at Microsoft, for example, look at Microsoft. It gives a return yield of 24%. Now, why? Because Microsoft's it's not nearly as wild and crazy as MSTY. MSTY, it jumps all over the place. It's a wild and crazy thing with lots of volatility. So it can return money a lot faster, but you're going to have to sit through lots of ups and downs on your core investment, which we don't really care because that's his problem, not ours. He's going to return it in 9 months. But if you do the Microsoft one, you're not going to have the ups and downs. You're not going to sweat the bullets if you keep looking at that number. But he's going to return it at 24% instead of 121%. So it's going to come in a little bit slower, but it's a little bit more stable, right? And it's going to take him 48 months to return your investment. So if you give him $10,000, it's going to take him 48 months, 12, 24, 36, about 4 years, right? About 4 years to get all your money back. But in the meantime, hey, you can spend it. You don't have to wait 4 years to get it all back and then spend it. You can start spending it today, but you're spending the future value of what you think he's going to return to you sometime in the future to get all your money back. It's not going to be a cash cow until 48.3. All right, 48.3 months. And that's an estimate because he might do better and he might do worse. And so we got all these different opportunities. We can come in here and we can do Apple. And if you think about these as individual businesses, all right, and not stocks or a stock portfolio, but you're like, I'm going to invest in his Apple business. And his Apple business returns my investment at a rate of 29%. I'm going to invest in his Tesla business because each one of them, to him, each individual fund is a business because he's going to take the money that you give him and he's going to go trade it against these different stocks. And if the stock goes out of business, well, his fund will go out of business and you'll lose all your money. That's how you're going to lose all your money, is if Tesla goes out of business. What's the likelihood Tesla's going to go out of business? Probably pretty low. Probably not going to, I don't know. If it does, we're probably going to have bigger problems. And, not that it can't happen, certainly can. Nick might think Tesla's going to go out of business, so he ain't going to invest in that one. But he might like Google and think Google's got a good future. So here's a Google business that you could invest in. You go put your money into the Google pool, and it pays back a rate of 50. All right. So at a rate of 50, it's going to take a little bit less time than Apple and a little bit less time than Microsoft. It's a little bit more volatile than those two. So it's going to pay out at about a rate of 50. So if you put $10,000 in, it's going to take about 2 years for him to get the money back to you. And then you'll be back to zero and you'll have a cash cow. And that'll be one of your gravy trains. All right. So that's how we want to look at these things. You put your money in here. Now, the idea is that we got to have money to put money in there. It takes money to make money. This guy can't trade options for you if you don't have any money to trade options with. Now, if you look at the rate of return, this is pretty high. That's a pretty high rate of return, 109%. It's just like a house, you know. Now, this is the advanced strategy that I really shouldn't tell you about, but you probably can figure it out on your own. So I'll just bring it out here and throw it out on the table, plop it right in front of you. Like a big hairy cantaloupe or something. All right, here's the big hairy cantaloupe. You could borrow money just like you do when you buy a house. When you buy a house and you think that's an investment property and I'm going to go rent it, make the money, and the rent's going to pay for the loan, you could do the same thing here. All right. You could go borrow $10,000. You could pay that $10,000 interest rate, which is right now right around 5 to 8, 7%, right? Annualized, 7% annualized. And you could take that money and you could put it into Tesla, which is going to pay you back at 109%, a lot more money than what you're paying to borrow the money. And you're going to make money, and you're going to have to pay the Vic, right? You're going to have to pay the vicar, or he's going to come and break your leg. But you pay the Vic because you're getting paid on your Tesla business. You borrowed money to invest in Tesla. He's going to return your investment with a larger percent return than what you're doing. You do it with houses all the time, right? You could do that. We call that margin. That's trading on margin. Some of you might be familiar with that. Maybe you have a margin account in your stock account and you borrow on margin, and that's how you trade in the stock market. Now, that's how we trade in the futures market. You can't trade the futures market if you're not on margin. That's the only way you can open an account in the futures market, is to trade on margin. So if you have a futures trading account, you're already on margin. You're borrowing money. That's how you have that leverage. Well, you could reproduce that same concept. Again, remember, think about the stock market as a sandbox, and you can do anything in there you want that's out in the real world. You can construct any sort of a financial deal in the stock market that you can actually do out in the real world. Okay. So you go out in the real world and you want to be in real estate. Well, you can do the real estate deal in there, and the same model that you're doing in real estate, you can take that and synthetically recreate it in the stock market. That's why the stock market is so amazing. All right. Because any financial deal that you can do out in the real world, you can come to the stock market, and there's tools, methods, and methodologies for you to go in there and recreate that synthetically in the stock market, so that you don't have to actually go out into the real world and do real things. It's for lazy people who don't want to do real things. Doesn't mean it's not risky, but going out and buying a whole bunch of real estate is risky too, right? I mean, anytime you do anything that's going to make you money, you got to risk something, whether it's a synthetic, cash cow here in the stock market, or whether it's a real cash cow out there with a piece of land and a cow grazing on it. It's the same thing. It's still a risk. Cow could die and you don't get your rent, right? Land could burn up. All your buildings on there could go up in flame. I haven't seen that recently. There's risk in everything you do. All right. Oh, this is too risky, lad. I'm not gonna do a Tesla thing. I'm not gonna do a Google thing. I'm not gonna do an Amazon business with this guy trading options. That's too risky. Instead, to make my money, I'm gonna go out and buy a house and put a renter in there. Well, that's not risky, right? That's not risky. It's not risky. Of course, it's risky. Anytime you make money, well, I'm just gonna go work as a dentist and I'm gonna drill teeth, and I'm gonna take my money and go buy Teslas. That's not risky. What happens if you get sick and can't drill teeth? What happens if you break your arm and you can't drill teeth? What are you going to do? Everything's risky. All right. Risk is the way life is. We got to take risks. What's the worst could happen? You lose your 10 grand. All right. Don't put more in there than what you think you can get back, or what you can what you can lose. If you can't lose it, don't put it in there. Don't risk it. You can't lose it on in the rental business, and you think you can do rent, don't do it. It's too risky for you, right? Don't do it. That's my little lecture for today, and I'm going to go and look at some of these stocks now and see if we can't get into some of them. This one here is ready. It is ripe and ready. It's down here on the Fibonacci retracement level, right? It's come back. This is Apple, and it's down here into the buy zone right here. You can see we got the buy zone right here. So what we're going to do is we're not going to buy right now because that blue light, again, as I mentioned before, usually intercepts right at the right spots to be getting into these markets. So wherever that blue light intercepts, that's really kind of where you want to be buying your shares, right? And that blue light hasn't intercepted yet. So what we want to do, draw our little natural trend line in there. It'll probably intercept right down in here somewhere as it'll come down. It'll accelerate if that starts to go up. It'll drop a lot faster and it'll intercept right in here. So what we're going to do is we're going to come in and we're going to come out and I'm going to go 37 days and I'm not going to buy an option. I'm going to sell a put. And if I sell that put right there, I'd be happy to buy some Apple stock right there. I'd be happy to buy that stock right there. And if I buy that, they're going to give me $535. And if the market's below that red line, by that purple line, they'll give me my 100 shares. That's cool. I'm going to take that $500. We're going to go ahead and we're going to see if they'll let me mark it in. Sometimes they don't. Yep, they did. Okay, so I got $500. There we go. We just offset this. We just offset one of these. Now, I also owe $500. So as you guys know, I'm not going to go into the great details of how these options work. But this is basically what our buddy's doing, who's trading our TSLY, from WiMAX, our WiMAX funds. This is basically what he's doing. He's trading options. We're going to trade some options too, because you got to make money to have money to give to him so he can trade it. So we got to make some so we can go drill teeth, or we can come in here and make some this way. And hopefully you make more than you lose. We got a bad move right here with Google. That Google's going off the wrong direction for this option because we bought one that said we we're going to make money when the market went down, and this market's not going down. It's too strong. We could just take our loss here at 992 and liquidate that thing if we wanted to. Or we could do a covered put against it. Anyway, it's not going to be a good day to do a covered put. I'm going to wait one more day. See if that goes. I might lose some more. What's the max I can lose on this? 1,168. I've only got $170 left in this thing. I got everything to make and nothing to lose. $170 is all I got left to lose. Let's come in here and let's do the same thing. We're going to come in here and we're going to sell a put. Sell a put. How much can we get? Can't get much. 370. That would help us a little bit. 245. We could put one here. We could 370. That'll help us a little bit. And we could buy some shares of Google down there. That wouldn't hurt us. Well, they'd take away our option. So we'll do that. That'll lighten the load a little bit on here. Let's see if they'll let us market into this one. And they did. All right. So that just collected $365 against our loss of, what are we down? $900. So 3,900 minus 3, that's 6. So now we're down $600 on this one. So we'll wait and see. All right. $600. And let's see, let's come in here and we're going to go to, we did Apple, we're long Apple, Amazon. Got to move this over here a little bit. Let's save that as our settings. Okay, so Amazon, now it's starting to rally again too. And we got, well, on this one, did we buy a put or buy a call? Oh, we got a synthetic. I think we did a synthetic short on this one. We bought a put and we sold a call. So we got a synthetic short. So we could do the same thing. We could come in here. This is actually what this guy does. It does the WiMAX stuff. He does synthetic longs and synthetics. I don't think he does synthetic shorts. He only does synthetic longs. Synthetic longs, and then he sells a covered call against it. This is a synthetic short, so he's going to sell a put against it. Same things we did on the other one. Just come over here and collect some premium. And we'll click $600. That'll help us out. Okay. Market, place that order. All right. So that is going to help mitigate this Amazon if it continues to rally. If it falls, we'll just buy some Amazon shares. That's what that means. All right. We'll buy some Amazon shares right there, 100 shares of Amazon right there. Or they'll just give us, what I say, $600. And that'll kind of help mitigate the losses on this one. Now, if this one keeps going up, we keep losing, we just liquidate it and just take our money here. But we're only down $125 on this one, and we just made $600 on this one. So we got a little buffer of about $500. So that's good. Apple, we bought that. We just sold that. We're going to collect $500. Mags, no options on it. Let's go. How come that thing's not working for me? I thought I moved that. I moved it on the other one. Didn't stick. Come on. Now stay there. Save and apply settings. All right. So let's come in. This is Meta. Meta's Draw our trend lines. Look at this. Every time it crosses at that thing, that blue light comes in there. Blue light, a little tough in there. Blue light came in. This one here, natural trend line. Blue light was a little late on that one because it came in so, but we got another blue light up here. This market's not falling. Meta met with Trump, bent the knee, apologized. I'm sorry. I was so bad. I'm sorry I let the government come in and take everybody's comments off of YouTube, off of Facebook. I'll never do it again. I promise. I'll never do it again. Do we believe him? Okay, there's your green. So there's your green buy zone right in there. Let's go in and sell some premium in here and see if we can't get ourselves some options. Okay, it's on a big up day. We should probably not be doing, we like to do this on red days, but you don't like to buy on red days because the red day's going against you. So you think it might keep going against you, and that's not a good thing. So, but if you buy on a green day, which in this case a yellow day, you don't get as much premium, but it's better than stick in the eye. Let's go do it. Let's come in here and sell a put. We're going to put this down here. That's 1,037. Wow. Well, that's 500. Well, that's because Meta is so expensive. Let's put this down here. We'll buy some Meta. That's $1,627 they're going to give me in 37 days. Let's go ahead and put that on. Margin requirement on that thing is $13,000 though. But I'm on margin. See that? Margin amount. I'm on a margin. I'm borrowing money to make money. I got $229,000. I really in this account only have $129,000, but because I'm on margin, they're going to give me $229,000. So I'm borrowing money to trade with. So that's something you can do. All right, so let's come in here. Let's go ahead and sell that one. We're going to market it. Let's see if they'll let me market in. You going to let me market in? Come on, let me in. Let me in. Let me in. Not going to let me in. All right, let's come down and look at what we're doing because we should probably really be checking out our table down here to see what's going on because we're going to be selling some puts. Let's look at puts. And we're going to be doing 37-day puts. So we're going to be selling these. $3,277 is the premium to collect on this Meta thing. Wow. Look at the volume, though. Volume 88, open interest 677. We really want to have it up above 1,000. So maybe we should do this one. So we'll come in here and sell that one. We could sell this one down here. That makes $2,300. Let's do that one. See if they'll market into it. Let's not even try to market into it. Let's just go ahead and put our limit in there. 23.25. 23. We got to go all the way down here to 25. That's a $15,000 margin. Boom. There we go. We got it. All right. They just gave us $2,325. Now, what's going to happen? Well, if Meta touches that purple line under that red line, I got to buy 100 shares of Meta. I still get my $2,325. That's mine no matter what. But I got to buy Meta at the rate underneath that red line. So I'll buy 100 shares of Meta, whatever it comes to under that red line. If it goes above it, I just keep my 2,300 and I don't have to buy Meta. So let's just hope Meta rallies from here, right? Of course, if we wanted some Meta, we could then do covered calls like that other guy, make money on that too. That's a good way to make money. Can't complain about that. All right, come in here to Microsoft. Woo, Microsoft's taking off, going to the moon too. All right, it's crossed the blue lights actually. Coming in with that intercept right there at the blue lights. That's a good thing. We like that. Every time it's done that before, you come in here and look at where it crosses the blue lights. Those blue lights cross. When it crosses, boom, 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 it goes up, 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 up. And maybe we'll see an up, up, up here. History tells us that that's what it's done in the past. Doesn't mean it's going to go up and go forever because it hasn't in the past, but sometimes it does. So let's come in here and we will come in and do 37 days. And we're going to sell a put right there. We can put it right at the money. If we wanted to buy some shares, we put that's $1,200. We'll pop it back one to that. No, I want it right there. We're going to buy some shares of Apple right there. $1,207 is what they're going to pay us to sell that option. And again, if it touches the purple line under the red line, I have to buy some shares of Microsoft, which is what I want to do anyway. And they're going to give me to do if I do it with an option, they're going to give me $1,207 to put my option right there. There we go. Let's come in here. And I'm not going to mark it in. Well, let's look down here. Yeah. It's all good. It's all good. We know it's going to be good. Okay, we're going to come down here to 1205. Okay, Let me have it. They did. There it is. We got it. They just gave us $1,205. I like making money. All right, here we go. MSTR. We're going to do the same thing on MSTR. Wait for the market to come to you. You're like, why didn't you do this last week? Sell these options because they would have been like 20 bucks. If we do it now, they're a lot more money. Big, fat premiums at these red lines. This red line's where you want to do this. So we got this red, the same thing. We're going to come in here. We're going to come in. We're going to do options. We're going to go to 37 days. Put option. We're going to come in here. You can see that the thing, this one's better down here. Or that one up there. 4,000. We're going to do this one down here. 3,800. Okay, sell that. It's got more option premium on it. Okay, there you go. We're going to come in here and drop this in here at 15. Ooh, that's a long ways down. 15, 15, 38, 15, 38, 10. 38, 10. Okay, $60 spread. That matches up down here. Yes, sirree. All right, here we come in. We're going to receive $3,810 if I hit that button right now. Oh, it just went to 37.90. Whew, I better do it fast. 37.90. Okay, here we go. Get in there. Get her in there. All right, we got her in there. All right, they just gave us $3,795. We're making money hand over fist today. All right, NVIDIA. We're going to do the same thing with NVIDIA. We're going to come in here and we're going to go 37 days. Let's come down here and look. $10, 3,000. Do we want that one? 500. We like NVIDIA. Well, I'd like to have my NVIDIA sell that. I'd like to have that NVIDIA right down here at that red line. That's only $350. If I think it's going to rally from here, I could put it in right here. That's $630. That blue thing is that blue light. See, that blue light is way up here. I think I could be a little bit more cautious on this one. I'm going to put it at the red line. They'll give us $350. $350 if you hit this button right here, land. 345 right there. Okay, place. There we go. They just gave us $345. We love making money. All right, Tesla. Huh? Nick, what are we going to do? Let's not put money into Tesla. Let's take some money out of Tesla. How does that sound? That line is drawn in there. It's not touched that blue line, but sometimes that blue line's a little bit higher and it keeps going. This is a 2-drive pattern, drive 1, drive 2. We are looking for that 3rd drive pattern. I think we're going to look at some Tesla in here. I think that in the next 37 days, Tesla is going to be above where it's at now. So we're going to come in here and we're going to 37. We're going to sell on Tesla. We're going to sell a put. Let's come down here and look. Got lots of volume on that one right there, but they've all got lots of volume. Just put it wherever you want it, land. That one's got lower spread. Sell right there. Yeah, we'll do that one. All right, we got to go down to 24.90. 24.90. There we go. They're going to give us $2,490 if we click that button. Do we want $2,490? Yes, we do. Boom. Thank you very much. Now I have $2,490. All right, let's go in here and Tesla. I'm not going to do Tesla. Tesla, we already have money in that one in our other portfolio. So do we? I don't know if we do or not. I don't think we put, this is our money making test. This is this one over here, this spreadsheet, this is our, we got to get some money into Tesla down here. We don't have any in Tesla right there. We got nothing. Let's see. I put 50,000 into Misty. And when are they on day 19? What's today? Day 15, 16, 17, 18, 19. He's going to give me approximately my best guess based on what he's been doing at the 121 rate, which I'm not sure if we're still at the 121 rate. That's he's going to give us $5,296. All right. Which means he's going to pay that thing off. He's going to pay that 10 grand off. This is 50 grand. So he's going to pay that 50 grand off in 9 months. So we've got that in Misty. We need to get some more money into Tesla. Tesla is a good buy right now at 109 rate. But we don't have any money. We took our money out of WiMAX. We initially had it in WiMAX. I took it out of WiMAX. We got $478 in WiMAX. I took that 50 grand. I put it down here in Misty. because that's Bitcoin. And 47, it's down a little bit, 47, but we don't look at that number. Remember, we don't care about that. We only care about the fact that we got 50,000 in here, and he's going to give me 5,200 for the next 9 months. And I'm going to have a cash cow. So we want to do the same thing with Tesla. We could go borrow money on a credit card. We're going to put 50,000 in. Where am I going to get 50 grand? I got to go over and trade. And I got to make $50,000 over here. I don't want to be in Tesla right now. I really want to put money in Tesla right now. I can borrow it from grandma. Grandma's going to give me 50 grand. If I did that, how much money would I have to borrow from grandma? 50 grand. Let's see, how many shares holding, cost, shares. If I wanted to do that, let's go over to data. We're going to go into what if, and we're going to go to GoalSeek. Oh, not that GoalSeek, right here. We're going to say, what if GoalSeek, we want to put $50,000 from grandma's inheritance. She's not dead yet. So we're going to borrow it from our future inheritance. All right. So that sounds like a good reason to get some money. Oh, let's see. That's not good. We got to have this number here. Cost, shares, price. Today's share price. We got to have that in here first. So that's 14.16. 14.16. Okay, that comes from that number right there. Today's current share price value, we're going to buy them right now. So we're going to have that. How many shares do we have to buy to get 50,000? Because grandma gave us 50,000 from her bag, from her brown paper bag. So we're going to take that money, GoalSeek, and we're going to take that money out of grandma's brown paper bag, 50,000. Grandma, I got a business opportunity I got to put some money into. Can I borrow some money? Does grandma charge us interest? No, grandma doesn't charge us interest. So there you go. We got 50 grand into Tesla. That's 3,531 shares. Our best guess is that he's going to pay us on day 27. Boom. 15, 16, 17, 18, 19, 20, 22, 23, 24, 25, 26, 27, 10, 11, 12 more days. He's going to give us $4,540 against our $50,000. All right. And as soon as I haven't got that calculated, let's calculate. Control copy, control paste. Okay. And in 11 months, it looks like recovery is 11 months. He's going to give us back our 50 grand. And in 11 months, we can give our 50 grand back to grandma. Okay. And then at that point, we have a cash cow and we can make $4,550, $4,540 every month as a cash cow. And we've already paid grandma back. There you go. All right, guys. If you want to learn more about this stuff, I have a magazine that you can subscribe to, and it helps you understand a lot of these things. We write all this stuff down in articles in our Pitt News magazine, and it's really a good little deal. Let me have Claire step in for just a second before I give you your Sunday school lesson. Don't run off, because I got a great little Sunday school lesson for you. But in the meantime, let's listen to Claire talk about Pitt News magazine. Should we do that? Let's see. Claire, take it away.
Hey everyone, it's Claire here. Are you ready to take your trading knowledge to the next level? Welcome to Pitt News Magazine, your trusted source for trading intelligence. Whether you're a seasoned trader or just starting out, this magazine delivers the insights you need to stay ahead of the market. Featuring articles from experts like Dr. Scott Brown, Aidan Gray, myself, and of course Mr. Lan Turner. Pitt News brings you exclusive strategies, deep dives into market psychology, and powerful trading techniques. Find out about the exponential power of growth, seasonal trading secrets, and even Lan's latest wild eye, crazy eye iron butterfly strategy. Each issue is packed with expert trading strategies, top stock picks, key seasonal trading insights, and comprehensive analysis of commodity futures and ETFs. You'll also find tips on technical analysis, option strategies, and much more. No matter your trading interests, we've got you covered. And the best part? You can learn your way. Listen to each recorded article, read the full in-depth lessons, or watch our video breakdowns. It's trading education on your terms. Right now, we're offering a special deal. Get your first full year of Pitt News for only $19.97. That's 50% off the regular price. 12 issues of powerful trading insights, backed by our 100% satisfaction guarantee. So, don't miss out on this limited time offer. Head to pittnews.com and subscribe today. Empower yourself, enrich your trading strategies, and stay informed with Pitt News Magazine. Trading intelligence right at your fingertips. Okay, let's get back to Mr. Turner. Thanks for sticking with me.
All right, all right, all right. We are very excited about the markets right now. And so I got a Sunday school lesson for you before I let you go. And that Sunday school lesson is size matters. All right. What I want you to do is I want you to take everything that I've done today because we really did a lot of really fun advanced stuff today. This is really good stuff, man. I mean, this is some of the best stuff I got to offer. And we're going to sell options. We're going to collect premium. We're going to get into the market. We're going to make money in the stock market. It doesn't look like it's a lot of money in there, a lot of red right now, but it'll pay off over time. And we'll manage those positions. And we got another spreadsheet. We're going to put all of our profits, and then we're going to take those profits and put them into these assets that actually pay a dividend back. And we're going to track that. We're going to see how well we do. And you don't have to jump in and do all the things that I'm doing here. This is a lesson. This is school. This is classroom stuff, right? And so I want you to grow into yourself. All right. You're not going to just take $1 million if you got that in there and start doing all this stuff with it. That would be ridiculous. I wouldn't expect you to do that. Nobody would. So you have to grow into your pants. All right. You start this thing, you might be a little plebe and you might want to start off with a couple $100 or a couple $1,000 just to start. See how it works, see how fast you can make a cash cow out of it, that kind of stuff. Do a couple of covered calls, do a couple of naked puts and see how that works. Put your toe in the water. Don't just jump all in with both feet. You got to learn. Okay. Size matters. It's easier to trade one or two perfect setups with larger position size, or is it easier to make lots of trades with smaller position size? I think that in the beginning you should do a little combination of both. I think you should do lots of small position sizes. All right, you can start to size up on some of them once you feel a little bit more comfortable with it, but do a lot of trading, but do small. Stay small. That's okay. All right. So don't bet the farm or grow on any one trade and then grow into your pants. All right. Grow into your pants, because when you first start this, it's a pretty big set of pants you're putting on, and you got some responsibilities to make sure that you don't lose that money. So tread lightly in the beginning until you get a little bit more comfortable with this thing, and we can move forward with that. All right. All right, guys, that's my Sunday school lesson for you. Be careful, start small, and learn as you go, and you can always size up later. Okay, that's what I got for you. If you had fun today and thought you learned anything or you enjoyed the lecture or the lesson, go ahead and hit that little thumbs up. That's always very helpful for me. Lets me know I'm on the right track and doing what you guys want to be doing. And we will catch you again. Tomorrow what's today? Today, Wednesday? Today's Wednesday. So tomorrow is going to be options, or is going to be in the afternoon. It's going to be power hour. And we're going to do a little day trading, and we're going to also look at the futures market and do a little bit of this type of trading in the futures market. We can do that too. I know a lot of you guys have futures accounts, and we're going to talk about some of the different opportunities that are over there to get into some of those markets. So we're going to do futures tomorrow, power hour in the afternoon session, 1 hour before the market closes, whatever time zone you're in. Okay, and then we'll be back and we'll work on this, and we'll look at see how our options are doing on Friday in the Friday morning session. And then our first day starts, our first class at the university starts next Monday. So if you've not registered for your class at the university, let's go ahead and get you done there and get into the university class if you are a local guy, or even if you want to, fly in and get an Airbnb for a week. It's last Monday, Wednesday, and Friday classes at the university. We get to meet in person. And I'm still working on that ranch idea where we're going to go down to my buddy's ranch, and we're going to all go down and go pheasant hunting and have my buddy come, and we're going to go stay at his ranch and have a really good time and have some lessons on how to do these stock investing strategies a little bit better one-on-one down there, or at least in person at the ranch. All right. And then we got ride four-wheelers. We can go shoot guns. We can do all kinds of fun things at the ranch. We need things to do, guys. We need to go do stuff together. All right. So that's what that's all about. Get us all out of the house, get us out where we can have some fun, breathe some fresh air, and enjoy each other's company in person. All right. We will see you guys. I'll get that information to you as soon as I possibly can. So go get Pitt News Magazine. That's how you're going to get the spreadsheets. If you want all these spreadsheets, I give them away for free to people who are subscribers to Pitt News Magazine. So it's $19 for a whole year. Plus you get all my great spreadsheets. So go do that. And we will catch you guys again tomorrow for Power Hour.